Moving on to our last piece of the night is our fireside chat, our main event. I'd like to introduce our speaker for the evening, Richard Brink. Rick is a fellow CFA and joins us this year from AllianceBernstein. He flew out to us from Denver, Colorado. I think it's a Christmas miracle that he actually made it. At AllianceBernstein, Rick serves as a senior vice president and market strategist with the firm's client group. Over the course of his career at AB, Rick has worn many hats, including leadership roles in the firm's alternatives and multi-asset group, senior portfolio management roles in fixed income, and investment director responsibilities supporting global retail fixed income strategies. Given his experience across global markets, I'm very much looking forward to a potentially wide-ranging discussion tonight. Rick also holds a BS in Applied Mathematics and Economics from Stony Brook University, and again, he's a fellow CFA charter holder. And one more fun fact that I learned on my last call with Rick, is that he is actually a world-class powerlifter. No joke. He has won national and world titles. I looked it up. I'm sorry for fact-checking you, but in recent years. So this is proof that discipline and strength show up in more than just his portfolio and investment advice. So without further ado, I'd like to invite Rick up to the stage. All right. Thanks for joining us.
It's great to be here. So I lived in New York for 30 years, and I moved to Colorado 10 years ago. I don't know by what miracle I was able to pull that off, but I was telling someone the story that I knew I had to get out of New York City because I had two young daughters. I'm an older dad. Later this year, I'll be 57. And I had two young daughters, and we were within short walking distance of Central Park. And we went for the first time with my first daughter, and she's less than a year old, and this really needs some acting out. And we go to put her down. I'm just carrying her, and I go to set her down. And as I go to put her down, she keeps curling her feet up away from the ground. She's literally she didn't know what grass was. She was afraid that the grass was something that she would lick gum off the concrete, but she didn't want to touch the grass. And when we finally forced her and she put them down, there was this moment where she thought she might melt, and then she goes, "Oh, this is pretty good. This is, okay, I like this." So I thought, you know what, it's time to get out of New York. And so we pulled it off. But I will say this, you have evil snow in Richmond. That is the most surreal, moonscaped, frozen, ice-looking. Our snow melts in 15 nanoseconds. I could have killed myself on a snowball. So it's amazing to be here. Next time, maybe this summertime.
Yeah.
But thank you. It's an honor to be here. It's an honor to be a CFA charter holder and just to get to talk to you.
So Rick and I have had some prep calls for this. And, unlike traditional forecast dinners where it's lectern, slides, kind of did something like this last year, more of a fireside chat format. But to throw another curveball at it, we kind of want to make this a little bit more non-traditional and not going to dive straight into the capital markets outlook. I know that Rick would like to take a step back and walk through what Rick and AllianceBernstein call building a better path and that framework. It's a longer term lens, on markets, investor outcomes, and I do really think that it helps frame the challenges that investors are facing today. So my first question to you tonight is, you argue that many investors are anchored to a period of returns that was driven by falling inflation, falling rates, and rising multiples. Can you walk us through this period, give your insights into what this means for markets as we look forward?
Thank you. Yeah. So when I became the market strategist, so most of my career was as a bond PM. And when I, through that roundabout way, I made my way to the market strategist role, one of the first things they ask you is, what's your story? What's your narrative? And I said, the biggest thing that I'm worried about is in a world of moderating GDP, and one would presume over time moderating market returns, how do I improve the probability of retirement plan success at a time when we have the largest retiring demographic in human history? That was it. That was basically my idea. And I wanted to communicate that we had a bit of I thought, a bit of a bias. So I'm obsessed with financial history. Obsessed is probably a strong word. Financial and economic history. And I guess it was born because when I was 13 years old, I'm living in small town Indiana. My parents are divorced. And my father, who was trying to be a pilot like his father, eventually gives up and wants to be a stockbroker. But don't think, Morgan Stanley or Merrill Lynch. Think like the lesser brother of Stratton Oakmont. It didn't go well, by the way. Every year on my birthday, back in Indiana, I would get a book, and it would be financial history. Imagine being 13 years old and what you're expecting, and then you get Den of Thieves, or Merchants of Debt, KKR, Barbarians at the Gate. But then I saw Pretty Woman, and I said, you know what, I think this is the industry for me. But what it did is it really started to ensconce this interest in financial history. And so whenever I talk about today, it's important for me to kind of talk about how we got here, because I think it says a lot when I try to frame my ideas today. And so, just for fun, this first chapter is called What's Past is Prologue, and these are the chapters. The first incarnation of this presentation was 10 years ago when I took the market strategist role. And I would get up on stage and I'd say, this is the S&P 500 going back to its inception in 1957, just a price level. Look at the annualized return, first of all. Sometimes we lose sight of this. It's the annualized return of the S&P 500 going back to 1957, incredible. But I would say, if you could pick a spot on here where you think, what happened here? And there were different picks, but a lot of the time it would gravitate to this spot right here, right around 1981. And you'd be right to do that, because if you look to the left side, going back to 57, the return was around 8%. On the right side was 12%. So using the rule of 72, I've got 9 years to double on one side, I've got 6 on the other side, which means in 18 years, 1 million becomes 4 on the left, and it becomes 8 on the right. So something very interesting is happening here. If you want to see a vertical line become a tent pole, you just put the 10-year treasury yield over it, and we get our first explanation for why this is. And if I'm going to introduce treasury yields, I'm going to give you the 60-40. Now again, keep in mind, this is average annual returns. So we were just talking about the S&P at 10 and change for the entirety of the period. To the right side of that vertical line, a 60-40 has gotten you 10 for decades. This is anybody who started in the market around 1980 or so. This is our entire careers. I really want to stress that. This is our entire careers. 1981, I'm still 2 years away from my first book, right? This is our entire careers. But now, if I want to dig in a little bit, it's that right side I'm obsessed with, because where that tent pole is, this is our entire industry. This is the growth of people, the growth of funds, the growth of assets, the growth of offerings, everything. The growth of compensation and where it starts to gap apart, all sorts of things. And so now if you look in that upper right, if you go over the entirety of the period, the S&P 500 is 10 and change. If you go over the 1981 period, it's 10 and change. If you go from 1981 to 1999, my first chapter that I call the fundamental super cocktail, bonds were up 11% per year for nearly 2 decades. and the S&P 500 was up 18.35% per year for nearly 2 decades, just for giggles. Who knew that? Who knew that the 20-year average there was 18? Your money doubles every 4 years. That's 5 doublings. Theoretically, 1 million becomes 32 in 2 decades. Nice work if you can get it. Yeah? This is what I was interested in trying to study. But the reason for it, for me, is this fundamental super cocktail. Nobody plans this super cocktail to come together. You, too, can have a fundamental super cocktail. It takes some advanced planning. First, you'll need a world war. Obviously, then you're going to need to have a lot of kids. Those kids are going to have to grow up. It's just work, work, work all day long. But if you do it, you can get the first ingredient in this, because the oldest baby boomer is going to turn 35 in 1981. Then we're going to get the rise of globalization. It's not our first made in Asia. We had made in Korea, made in Taiwan, made in Japan. But this would become the world's largest factory floor. You just need a little ping pong diplomacy. Got to look past a couple of sticky wickets in terms of policy, and you can get Deng Xiaoping's For Modernization speech in '79, and off to the races goes the world's greatest factory floor. Then we can get the digital age in '83, and we can get the rise of what I think of as Microsoft Office meets the internet, but it's everything we know in the tech world. And that peak in rates that had to come about, by the way, if you want incredible returns, if you want to get to the peak like a roller coaster, you have to come up the other side. So this is the lamest thing I can come up with, but I say it all the time, and yet I keep doing it. If it's like a roller coaster, if you want the whee that comes from having those kind of rates, you have to get to them. Quick reminder, what was the range on the Fed funds rate at its peak? 18 to 20%. 18 to 20%. To get the whee, you got to have a tall roller coaster. And if I'm going to get globalization and automation, I'm going to gut inflation by way of goods inflation. I'm going to get deflation for decades, and that's how I'm going to get this. But, and here it is, by the way, there's inflation. There's the slower moving 10-year treasury, because 10-year inflation expectations die hard after the 70s. Little trivia point, the steepest and most inverted curves in modern history happened within 1 year of each other, thanks to the cuts, steepest and most inverted. And then we get the Shiller PE, my favorite, because it's slow moving. It's 150, almost 150 years old. And over this time period of 20 years, it'll go from a 6 handle to 45. John and I talked quite a bit about Shiller PEs when we got together, our little budding bromance that's going on. Look away if there's affectionate googly eyes. So this was a big thing for me, because that's absurd. It's absurd. And recently, what was the month-end number? 42.7? Near month-end?
42.75, yeah.
40. What are you trying to win a forecasting competition? It's not on there.
Last year, I was only off by 5 basis points. I award myself great marks.
So, but the issue here is, yes, the fundamental super cocktail is incredible, but at some point, those ingredients start to fade. The oldest baby boomer starts to exit their peak earning years 20 years later, and they'll start to walk themselves out the door. The gains from productivity start to flatten around. Yes, we're going to have continued globalization, but we also are getting down near the bottom in terms of rates and inflation gains. And instead, we start to push a little too far and a little too hard. And you'll notice seeds of populism and deglobalization, anti-globalization. I draw the straw as the chief market strategist of building the election deck every 4 years, presidential election deck. You want to know the most thankless deck a human being can create in our industry? You try to walk down the middle, and the only thing you get is equal hatred from everyone. But I promise you, I can explain every major developed market election in the world because of the fundamental super cocktail and its aftermath. Look to the left, there's a household paycheck proxy and corporate profits. Note where it gaps apart. By the way, this is like crop circles. You'll never unsee 19 or 1981 in a visual again. Take a look at the second graph. This is real income gains by income tiering in the 35 years or so after World War II, leading up to 1980, and the 35 after. Look at the lowest in the middle in the 34, 35 before and after. The gap in compensation for having a degree versus not explodes, almost doubles between 1979 and 2000, then flattens out, and then the ever-famous Gini coefficient. Notice the 1980, notice the peak. That's why most elections today, policy-wise, are about raising the drawbridge or redistribution. How do I unwind this? But the thing is, we start to push a little too hard, a little bit too far. And this is Buffett's household net worth to GDP favorite. Notice it stays in a range for decades. Then it explodes out into the rise of the tech and then tech bubble, as we were just talking about. Then we get the GFC. Then we get, for a first in a long, long time, going back to the Great Depression, an enormous fiscal and monetary package. By the way, I'm not going to probably get to this visual, but if you were to put COVID on this chart, true story, not making this up, because I tried to do it and legal wouldn't allow me to do it because the dot for COVID is up near the word trade on this slide. If I posted H&W to GDP with COVID, it sits up near the word trade. Extraordinary, isn't it? Okay, and one last thing. That leads us into all the packages that we start to uncork. So on the right-hand side, what you're looking at is the S&P's price level and the Fed's balance sheet. Some things are hard to interpret, some are not hard to interpret. Dump a gajillion dollars into markets and markets go up. Start to take the money away and they stop going up. This is when Build a Better Path was created, the fundamental super cocktail in our first fiscal and monetary. I thought that was going to be it. Returns were going to be flat because we've run out of both. I was right for 2 years. Unfortunately, one of those dates that I reference is the date of the presidential election, and we get our second burst of fiscal and monetary. Little anecdote, only tax cuts to happen in the history of the United States as a nation when we are at peace and labor is improving, and the Fed's reversal in 2019. Remember, Powell's, we're not even done, we're not thinking about stopping raising rates, and then they reversed within 3 consecutive meetings. Second massive burst of fiscal and monetary. Now I think, okay, that's really it. This is the time where it's no longer going to have these bursts. It would take something absolutely extraordinary, absolutely otherworldly to produce the impulse you would need to get the fiscal and monetary that would drive markets still higher. And as I've said before, I unintentionally uncorked COVID. And so if you put it all together, this is 45 years where I would submit to you that my opinion is the first 20 is driven by the greatest unplanned combination of organic drivers in modern history. But after we'd sort of run out of that juice, we've been gearing ourselves to a large degree since and bailing ourselves out of a lot of problems, or when we don't even have problems, through massive fiscal and monetary. And so what that's been doing, Bengen's legacy, Bengen's withdrawal plan. If you retired in 1981 with $1 million, you said, please, I hope it makes it 4% a year inflation adjusted. Turns out you didn't have to worry. 1 million becomes 13 million if you retired in 1981. Took all that money, retired in $13 million. Enjoy that island you bought. The second one, 1991, returns are falling, but now sequence of returns enters the chat, 2001. Yeah, this is what basically has obsessed me for a long period of time. And so it's this idea that plans die on the left if you have a significant drawdown early in retirement. And so I'm trying to stop plans from dying. How do we do that? Because back in 2008, right at the peak of the financial crisis, after we got hit with September and October, the probability of a plan fail was 3%. But all of this stimulus, what it does is it draws returns from the future and pays it into the present. And by 2019, that probability of plan fail had grown to 27. Imagine explaining to an end investor there's only a slightly better than 1 in 4 chance you'll end up living in a box at some point in your life. So this is my obsession. And from a market performance perspective, one last thing I want to show is in 2020, after all the COVID stimulus, and we'll go right to questions. Thanks for being patient with me.
You're good.
Is like, I did tell you that there was a 0.75 in my prediction.
2020. In 2020, models were saying that the expected return in stocks was 4.7, bonds was 0.2, and inflation was 1%. Now, why this is important to me is the probability of fail 1 year earlier was 27%. After 1 year and all the COVID stimulus, the expected return was down to 3.1. I didn't get a chance to run probability of plan fail. A lot was going on then. But I estimated it was 35 to 40%. And the major driver was bonds. Bonds were the culprit for the rise in fails. That's negative 80 basis points of expected real returns. Again, 60-40, the whole mean variance and countercyclical. Why that magic level of 2% real matters is if you do the math on what it takes For a 30-year retirement plan to work, it's 1.35% real. Your buffer's 65 bips. You have no buffer against drawdowns. A plan dies because of a significant drawdown that forces the selling of impaired assets, and you never catch up. We've had massive buffers. Remember the island for the guy in 81? As those fade away, we get more and more exposed to this. Fiscal and monetary bails us out. My existential question is what happens when we lose the interest in a significant drawdown? Also, as bond yields fall, they can't be the offset. Notice bonds' performance over time as yields fall. You can't get real yields in a good market. You can't get offset in capital gains in a bad market. And lastly, every model that predicts probability of plan success is predicated upon the idea that what stops you from selling impaired assets is the income the portfolio generates. If almost half of the portfolio is generating negative real yields, then we can't use that to save ourselves. And so as we get into the capital markets component of all of this, what I want to bring up is where this has changed is the second part of COVID. I thought that when COVID happened, just the massive fiscal and monetary was a continuation of a trend. But the last thing I want to hit here, the last two slides, is this was an era of the most incredible inflation that I think we've had in modern history. Is anybody a fan of Marvel movies, just out of curiosity? Show of hands with the non-food forkhand. 3 people. How did it make all the money? It's non-CFAs going. Okay.
You at least got 3. I had a no-show on my 30, 20, and 10 year.
Oh, right.
Well, anyway, sorry.
So, all right. So, look, I just want you to think about this for a second. So if there was a league of supervillains of inflation in American history, one would be 1918, global pandemic, right? We got one of those. Next would be the reopening in 1919. We got that. They also had pricing pressures in 1919. After that, we get the first European land grab since 1945. We also get the housing lock-in effect, which started in the 60s but peaked sort of in the 1980s, 81 for me. And then we get global tariffs, first time since 1930. This is the league of inflation supervillains. The average distance to all of these is 82 years, and they showed up back to back to back to back to back. And why does that matter? Because obviously inflation expectations jumped, and models had to recognize it. Real yields went with it, and this is the major story in portfolio construction today. This is why I wanted the little history lesson. If we don't have the league of supervillains, I'm probably 4 years later telling you a story of low expectations for returns, maybe the Mag 7 saves us, but probability of plan fails are high. But the moment inflation expectations started to track into models, real yields were higher. Look at the difference in expectations around real returns in bonds. Negative 80 5 years ago, positive 170, that's 250 bips in the 40% of your portfolio over the next 30 years. So for me, all conversations about portfolio construction today, as much as we'll talk about equities, begins with the riddle around inflation, its ability to persist, or if it is in fact, wait for it, transitory. If it's one of those two, and what does that mean for real yields, and what does it mean for portfolio design in about 2 years? And so that's my segue. So hopefully a little history lesson, or at least the markets lesson, was a little fun while you finished eating. But that's my setup for why my comments are going to reflect inflation, rates, and then to the equity stuff.
So a global pandemic and inflation may have actually been a good thing?
Yeah. It's like a stay of execution in a 60-40. That's a great point. Because if real yields are sitting, look, when real yields peaked, they peaked at 2 and change. Remember I said that the math for a Bengen is 1.35 real. When real yields were at their peak, you could have gone out and bought a laddered portfolio of tips. You could have acted like a pension fund, contingent immunization. You need 1.35 real. You could have gotten more than that across the curve in tips. And as long as we pay our bills on time, retirement's over with room to spare. Before COVID hit, that was a non-starter. You had negative real yields and very low nominal yields. That was such a massive difference for retirees that I could have put it on autopilot at the peak of yields. And so the question is, how do I attend to duration right now? Because if it is temporary, then that gives us our window where we have to do something about it. Either we capture the yields, or if yields come down quickly, we capture the capital gains as yields come down. But one of the two, I think we have to bank it.
So if we all accept this framework, what do we do differently? What changes most meaningfully in how portfolios should be built today and going forward?
I'm a big sequence of returns guy. If I'm accumulating and I'm patient, then the sequence of returns don't really materially matter. But the moment cash flows are in play, sequence of returns is everything. And it becomes a critical part of the success of a portfolio. We've ripped this 50 ways to Sunday. But a lot of the time in conversations, it's not a common feature when I have chats to design a portfolio around the path of the returns as opposed to the expected level of returns. And so I, for a long time, have studied persistency of sequence of return, persistency of up-down capture. So I'm a big up-down capture guy, but I need to understand where it comes from. So I think one of the biggest changes for me in portfolio design. Now, by the way, if every time the market goes down, we are going to take on additional massive deficits to bail the market out, ignore what I'm saying, enjoy your dessert, attempt to laugh at a couple of my jokes, and we're fine. But just on the outside chance that at some point we don't do that, since we are talking about maybe a tech scare, we're worried about tech and where it goes from here. As it turns out, the last major crisis we didn't dump fiscal support into was the tech bubble. And my sort of trick question for the room is, after the tech bubble burst, how long did it take for the S&P to reach that prior peak and hold it? That's the trick part. How long did it take to reach the peak and hold it? We had no fiscal support here. It was just the rates. And the answer is 13 years. The oldest baby boomer, like my dad, 35 in 1981. He's building his portfolio right before the bubble pops. He's 54 years old. The next time the S&P will get there, he's 67. So I ask myself all the time, what happens if we have a meaningful decline in markets, but we don't run to the rescue by buying everything that isn't nailed down? And what does that mean for an awfully large retirement cohort with quite some way to go? And so sequence of returns, I think, helps us. And when we do that, it brings up some non-traditional betas, some that we know but maybe don't think of it the same way, because I'm not looking at it through the lens of absolute level of return. I'm looking at the persistency of the path. And so can I get a spread between the up and down capture, a ratio over 1? You'd be surprised what that does to portfolio success.
All right, this is more of an off-the-cuff question. If I think high level, the big events where we printed a lot, ran to the rescue, dumped, liquidity at the problem, it was a global pandemic and it was a global financial crisis where the system each time was unraveling at the seams. .com, to my recollection, I was relatively young at the time, didn't seem like a too big to fail or unraveling at the seams moment. With the Mag 7 doing what they're doing, would the AI tech build out that's driving returns lately be a too big to fail moment?
Let's ask the audience. Here we go. Audience participation. The Mag 7 starts to crater. The AI trade starts to fall away. People start to worry we're building bridges to nowhere through data centers, but we're not getting ubiquitous use. We have a crash that's similar to the tech bubble. Just by an involuntary show of hands, how many believe that the Fed, the Treasury runs in co-partnering to save the tech world again? Thanks for having me. It's been great to be here.
I don't know. I think it was at 50%.
Okay, that
40?
that looks like you're shielding your eyes from the hands. It's
Right.
look, that's the question. So that's the option value of that question is everything to me. If the answer is no and we get it, that's an unbelievable world of hurt through the developed world. Just looking at the age breakdown across the system, that's unbelievable pain. And so so as you said, there were big reasons. Now that middle bit about the tax cuts and then the Fed reversing, that's maybe a separate animal. But on the left-hand side, when we get the GFC, that's systemic, that's the banking system. That's, Grandpa, tell me the story again about how Morgan Stanley became a bank and Merrill got bought by one. I sleep like a baby after that one. And then obviously when we had, COVID, everybody's staying home. What are you going to do about it? You put a moratorium on mortgage defaults, all of that stuff. So yeah, that's the big thing is what does it have to rise to? Is AI a too big to fail thing because of capitalization, concentration, and maybe an awareness of what it literally means to national wealth? I don't know the answer.
Here's another off-the-cuff follow-up. Is the S&P 500 itself as an index with everything passive and active, for the most part, tied to it, at least in the U.S. equity space, is it now a public good that needs to be saved itself?
Wow, we are that's a sticky wicket if we decide that our primary index must be saved. I'm not saying it's wrong.
Because if every retiree is tied to it in some way, shape, or form, does the S&P get to be too big
welcome
to fail?
to my nightmares. This is literally when I've tried to think about this. We've gone passive, the amount of money in the S&P, the concentration inside of the index. Are we protective of the constituents that lead? Are we protective of the index as a whole? I don't know the answer to it. I'd like to believe no. I'd like to believe at some point you were on your own. Nobody forced you to buy the spider. But I don't know the answer to it. Because I don't know the answer, if I just pretend there's 25% of an AI crash, that's a 1 in 4 chance times whatever we think the probability that the government jumps in, that we have a really, really difficult expected return. And because I don't have line of sight, I start asking myself, rather than that, what are the ways that I can practically defend? And that's where sequence returns and betas. So I'll talk about Mag 7 all day. Lord knows I've been forced to do it by my firm. I have all these series I do. First it's labor and technology, and we're quoting Keynes and Owen, and then there's the S-curves of adoption and what has to happen there and what physical AI looks like. And the supply chain of AI, and no data center, no AI, no energy, no data center, all of it. But I actually think quality is kind of sexy. I think high yield is an equity surrogate that most people don't use. I think high yield lives on the equity side of the bucket. I think historically high yield has incredible equity-ish behavioral characteristics. And did you know that if you buy high yield bonds, and this is not just because I'm a bond guy, I'm now off that desk now. There's no commission coming my way, right? We can supply this chart to you. If you take every single day since high yield was incepted officially in the 80s, its first big index appearance, and you look at every single rolling 5-year period, and then you put the 5-year forward average annual return of high yield over the top of it, they basically sit on top of each other. And there's a reason for it. In fact, if you give me 4 to 6 years, okay, most high yield bonds, there's going to be a quiz at the end. Most high yield, but you didn't ask about high yield spreads, by the way. We'll have to work that into the questions next year. Most high yield bonds are 10 years maturity, and they're callable after 5. That's the classic. Nobody wants to go hat in hand to try to borrow in a market against a difficult backdrop. So almost everybody hits the bid at 5 years. So you get paid after 5 years. The life cycle of the index is 5 years, and people ask, well, wait a second, don't high yield bonds default? They do. And then there's some level of recovery, so the number that matters is loss severity. But there's a bit of an offset there, because if you hit the bid at 5 years, you get a call price, you don't have a par price. And so what history kind of shows is, for the most part, with like 6 asterisks behind it, is that the premium from the call is roughly equivalent to the loss severity. And so you walk away with a yield with a striking predictability. And so if I was trying to build a portfolio that had a fraction of, say, equity market drawdowns and the R squared on an instrument that tells you what you're going to earn, its ability to predict that number, what other assets do we have that do that? So as a widget, right now I'm not thinking about the level of return, I'm thinking about the widget of a beta that has high predictive power from T0 over a 5-year rolling period, and how does it get used in a portfolio?
So if I'm reading it right, we want to build more all-terrain type portfolios going forward because those will manage sequence risk better than traditional passive.
Yeah. I mean, I get asked a lot about, so we're not the, so in one of the CMOs, I came up with the S&P 493, and I put it in the CMO. And I thought that I was incredibly clever. I said the S&P 493, and then I saw some other articles with the S&P 493, and I said, clearly, these other investment firms have seen our CMO because they're copying the S&P 493, and then it dawned on me that pretty much everybody knows how to subtract 7 from 500, so it probably wasn't quite as original as I thought it was. But what I would tell you is, in conversations, I sort of separate those two into two conversational camps. And we get to have a conversation about AI and how strongly we feel about its upside or potential downside. And based upon that dialogue, the conversation that comes with it is then, how do I structure the 493? Because it's inside the 493 that I can have even more command of the sequence of returns. I can use that as a beta pairing or enhancing element, right? So depending on my opinion on one side of the camp, then the other things on the opposite side start to play a role in modulating the beta and modulating the downside profile.
So I just looked at my watch, and I think we have about 10, 15 minutes before we need to open it up to Q&A. So I would like to push over more into the capital markets outlook. So building a better path, building more resilient portfolios, noted. Looking forward, if we talk about macro and the Fed, your outlook describes growth as solid but fragile. What's actually holding the expansion together right now?
Well, to state the obvious that everybody in the room knows. By the way, this is such a fun way to do something, because you share a room with CFA charter holders, and almost everything you say, everybody in the room goes, "Yeah, I know." Also a charter holder. Did you see my name? Right. But we refer to growth, inflation, and labor as the Trinity. Ever since COVID, the capital markets outlook, which used to have a pretty small macro section, grew to 20-something pages. And it stayed there for multiple years. And we sort of made our way around whether we were focusing in on inflation out of the gate, right? And then it was a question around growth. Then we had questions around labor. Now so it was, labor was too strong, the ability to command wages, that was one part of this cycle. Now we're looking at labor where no further cooling is warranted, according to the chair. And so labor is probably the biggest, labor for most of us, I guess, is the big question mark, because we're sitting where we're basically not hiring, but we're not heavily letting go. You're starting to see some of the cracks in the numbers, some of the jobs numbers with the shutdown in data, as we're trying to see what the trend is on the other side of that. There are some estimates around job cuts, challenges, stuff like that suggest that they might be pretty aggressive. So what's holding the expansion together right now is a strange form of consumption, because GDP is the expenditure method, it's what we spend. And on the business side, it's AI dominated. I'm sure everybody's seen the chart that if you take that kind of spending out, GDP goes to a flattish level. And then on the opposite side, it's the wealthiest consumers that are generating most of the consumption inside of GDP. So if I've got this section or segment of the consumer that's propping things up, and I have a segment of business that's propping GDP up, then right now I'm pretty reliant on, at least from a number of firms and number of people basis, is a fairly limited set. And so now I'm relying on that to continue, and to continue in such a way that we don't crack or fall out from the bottom in labor. So I'd say that's the fragile part, is the no further cooling warranted, and the fact that the way we're getting our growth is coming from very specific parts of two different camps.
What about productivity? When we look at AI, we look at technology, we've seen a lot of the GDP growth on the tech side, the Mag 7. You know, one, will they be the beneficiaries of what they're building out? And will the productivity expansion in the 493, will that be the next story over the next decade? Will that be sort of the changing of the guard or changing hands of it's in a limited few and now it's becoming more proliferate?
If history is a guide, the answer is yes. That's the tech bubble. Remember old economy, new economy, right? Those of us around, old economy, new economy. The new economy was going to drive everything. Pets.com was a perfectly fine idea, right? That. And then the old economy, I was at Dreyfus. My first 10 years, I was at Dreyfus, owned by Mellon. And when the tech period was roaring, Mellon was terrified of losing qualified, talented people to the tech world. And so overnight, the entire Mellon organization got a not insignificant raise. We had to wear, you usually wore suits 4 days of a week and you had corporate casual. By the time they were done with this employer of choice campaign, you could show up in a bathrobe trying to do a Hugh Hefner and it was completely fine, right? And everything was relaxed, right? And then the tech bubble popped and they're like, put your stupid suit back on, right? But it did happen later on as this stuff starts to get entrenched, right? It's hardware, it's software. How do we figure out how to use the internet? How do we get most out of it? What actually sticks around? Then we started to accrue to the old economy. And that's supposed to be the same thing here. That's the whole ubiquitous thing, right? So right now, when you first got ChatGPT, or whatever your AI of choice is, were you trying to answer the most existential questions, or were you just having a little bit of fun? Because I was having a little bit of fun with my new toy, right? And I picked the AI that was the most cheerful and thought that everything I said was brilliant, and then I realized that's every AI, right? But I do believe that once we figure out how to get the most, like when Microsoft Office came out, folks didn't really know how to use PowerPoint initially. I was there when we got the first contract at Dreyfus. They didn't know how to use Excel. PowerPoint was a mystery, right? All of that stuff. And eventually, over time, each person gets a little better. Collectively, we get better. Then suddenly, everybody uses it. Now, Excel, if you don't know Excel and you're a young person coming in, you can't get the gig. But back then, it was a mystery. You don't get the gains immediately. It has to be absorbed. It has to make its way across the system. And if it's good, it does have to enhance all the other businesses. The big question and I do believe it will, I think that the most important question in markets is the labor impact, right? I'm sure that debate is the biggest one, is what's the labor impact that comes from all of this?
So, going forward, given this backdrop, where do you see the best opportunities from here? What are your views on, and AllianceBernstein's views on alternatives? And are there any strategies, you've named quality, high yield in particular, but are there any others that you think make a lot of sense right now?
Yeah, so inside of that, under the auspice of the way I tried to frame the 493 with sequence of returns being important, I am going to throw high yield. I am going to throw quality. I am going to throw dividend growth. But the devil's in the details of how you define it. If you ever want to have some fun, look at the dispersion in the U.S. large cap quality ETF space in any given year between the best and the worst in quality. The dispersion is so large. We think we go to the shelf and we pull whole milk off the shelf. It's just whole milk. And then you see the dispersion is 700, 800, 900 bips in a year between best and worst. Quality is a characteristic. It's not a metric. How you measure quality is where there's massive dispersion. So the devil's in the details on a lot of these. But the sleeper I'm going to throw out And I'm doing it for you because we talked about this at the beginning. When you started early on, what was your favorite area to invest and what almost brought you down hard?
Value.
Value. I got that little nugget at Drinks. Value, there is growth in value. One of the series I did was there's growth in value. Remember, so we had at Dreyfus, at AllianceBernstein, sorry everybody, AllianceBernstein, I know where I work. AllianceBernstein, when we merged, Bernstein was the value camp. Alliance was the growth camp. Value, after the tech bubble, sort of ruled the roost. And the strutting that went on over value for many years, and the returns were incredible. And with a straight face, people would walk into a meeting and say, do you want the value portfolio that's targeting 300 bips of alpha a year, 500, or 700? These were real conversations. New charter holders are like, I'm in the wrong field. 700 bips of alpha on order. And so after 2008, as we know, when value went pear-shaped, over all the years that followed, now obviously active flows have sort of disappeared, but what's interesting about value is passive positive inflows only happen in 2 years. 2018 tied to the tax cuts, 2021 tied to the inflation. And those trades unwound within 2 years. But there's growth in value. That index has changed, its makeup is different, and you'll find companies inside of there that relate to AI, relate to that trade, that they haven't had active value extracted at the level that we think is there. There's a portfolio that I won't talk about that no one in this room is able to buy anyway, so I guess it doesn't matter, but the alpha being generated inside of value in some of these more concentrated portfolios is exceptional, and it would do past you proud. So I would throw value into the mix. And then alts, look, alts is its own presentation because there are so many different types of alts. One of the first presentations I built when I became an MD was demystifying alts and finding the essence of what drives each type of alt. But I am a believer in private credit. But that's because I'm a believer in credit. By the way, the best tax-adjusted beta that I found in all my travails is muni credit. Muni high income is my favorite beta in markets. Muni high yield, my favorite beta in markets. So credit is something I like for the reasons I mentioned in high yield. That residually flows through to other things. Private credit, in theory, and at least according to the data, in the numerator, I get more up capture versus high yield because I have a liquidity premium of some type. In the denominator, because I'm able to make the direct loan, I have some control over the loan covenants, and therefore loss severity, at least according to data, is supposed to be lower. And so if I'm an up-down capture guy, starting with high yield and enjoying that and talking about it as an equity surrogate, then of course by extension, something with a liquidity premium and a lower loss severity, I'm going to be interested in. But again, the devil's in the details. The loss severity levels are big. There's an awful lot of money in the market. I don't have to tell anybody in the room how much money has made its way in. So the ability to deploy that capital so that you produce that loss severity, because I had some conversations with folks that hadn't been in the markets for a long time, and it's sometimes lost that private credit was a GFC element and a major part of the GFC. And so it's not easy to get that, obviously, and the ability to handle, in other words, how am I tying assets? How am I encumbering assets inside of private credit so that I target the loss severity being as low as possible? Yes, the yield ranges are a little different in private credit, but for the most part, like public credit, there's a general going level of yield at a given level of credit quality, generally speaking. That's not the part I need to debate. I just need to get into the denominator and figure out who's best able, based on the type of private credit or the way they go about it, that they can mitigate the loss severity. If you can do that, and then somebody's willing to wait through and not run, I think there's great opportunity there. Now, I could talk about quant. I know you want me to talk about it. No, I'm just kidding.
No, it's getting late. They don't want to. So I've got one more question, and then I'm going to open it up to the room. Where do you think investors right now are most complacent?
I don't think we respect major drawdowns. Not us. We're CFA charter holders. But no. But I think when you talk to casual investors, there's sort of a split camp on a belief in what a real drawdown can be because we haven't had sustained periods. There's the wringing of hands and the gnawing and thrashing and all of that stuff. But COVID hit new highs in a handful of months. And in the GFC, we were quickly, it took a little while to settle and it was brutal. But remember, we put not one, but 3 programs in place to stabilize money markets right out of the gate. Right? And so I think a healthy respect for what a downside could look like, because there is so much emphasis on alternative intelligence, Mag 7 and those companies. And I'm not saying not to own them. It's a preponderance of the evidence when so many of my conversations are, what should I own in AI? This is the area I want to be in. This is where I have a lot of my portfolio allocated. And when you hear that enough, not just in the US, but in other parts of the world, I start to worry that we focus too much on maximizing the level of returns as opposed to optimizing the sequence and the combination of upside and defense.
Thank you for that. I'd like to open it up to the room. It just occurred to me, do we have a third microphone, or we do? Awesome. Can I get Chip again? You're my man.
Is it working? Yep. I was wondering if you had any perspective on, the government now taking interest in various industries, businesses, and how as investors, we should be thinking about that.
Thanks a lot. Look, for me, that concerns me. It's a new form of too big to fail, too invested in to fail. It's supposed to be free market capital, and this, at a surface level, it concerns me that there are portions of capital markets that we will take ownership in and support, and others we don't. And I'm just not sure what to make of that. And political leadership changes. And so what is the sustainability of that support over time? Is this something that, if we start to take it into account, is this something that we assume that it persists and that it will survive administrations? Or is this something where this is a just visiting kind of phenomenon, and then you have a rug pulled out? And so what does that mean for us as analysts? So I have free market questions myself, and just, companies succeed and fail of their own volition. I have questions around the permanence, and I have questions around the vetting process of who gets that treatment as opposed to who doesn't.
You mentioned the before and after 1981, and it seems like you're expecting inflation to continue. I don't understand how high yield bonds fit into that if interest rates continue to go up. And would you be looking at commodities as well?
Thank you. No, so my obsession with the 80s isn't a belief that we're going back to high inflation. Most of my obsession with the 80s is pop culture, film, the greatest music of all time. That's where my obsessions lie. Everybody knows that. It's documented. I actually think that I agree with Powell that in the absence of residual trade impact on goods, that we'd be trending closer toward the lower twos. So let me back up. So COVID never happens. None of the League of Supervillains never shows up. None of that ever happens. I'm sitting on stage and we're having a discussion about some of these waning measures that caused some of the deflation and disinflation. We're talking about if not deglobalization, some of the waning benefits accruing to globalization. They've largely been grabbed, right? So forget just doing away with globalization. What if simply we don't get the gains accrued that we used to? We've done all the low-hanging fruit. So that's sort of out of the way. We have an aging population. What does that mean for spending dynamics? And so the argument has been, and that we've talked about at the firm, is in that world, inflation is higher than 2, but is it 2.5? Is it 3? But it's somewhere in that world. It's the idea that structurally, as some of these ingredients cede and we move into a different type of a demographic discussion, do we pop ourselves up into a 2.5 to 3 level? That's what I think the conversation is without COVID. With COVID and everything else, I think in the absence of 1 or 2 of the supervillains on the back end, we're already down in the low 2s. So now one of the big questions is about, and Powell's comments and something that we talk about is this idea that our tariffs, are they a step function move? And then it's out. Because as a reminder, again, room full of CFA charter holders, CPI is 12 contiguous months of data. So every month when CPI comes out, we're dropping 1 month, replacing it with the other, and the other 11 are the same. So it's a sort of slow-moving animal. But I would suggest that if indeed, like it was in the first administration, although there weren't as many moving parts, it's a pig in a python. Let's pretend, just for academic effect, that everything hits in 1 month. That 1 month is going to carry the burden of inflation for 12 months until just by rule, it drops out. And so in the absence of that, another driver showing up to extend it, then it goes back to 2. That's just math. That's the way it's math. And obviously the Fed and other central banks refer to that official data in some of the decisions that they make, and they track off of it. So actually, what I believe is unless we start, and that's a separate conversation, maybe after for second round of drinks or something, what allows more perpetual inflation? And that's yet a third conversation. What allows for legs inside of inflation, and what does that mean in terms of level and duration of it? But if you were to wipe all that away, I'd be arguing for somewhere in the 2.2 to 2.6 range on inflation. Now, from a high yield perspective, as long as or yields in general, the two things that you have to that at a high level you have to attend to are the level of the yield, yes, but 2, the variability of the yield, volatility inside of the yield. That shows up in a lot of things: mortgage rates, hedging the book, all of that stuff. But the volatility. So if you said to me that whatever inflation settles at, there's low inflation volatility, the variability of the rate, and the market settles to that level, 2.2, 2.4, 2.6, okay, great. That shows up in inflation expectations. That goes up into the yield. That shows up not just in high yield, but in treasuries and everything else. If we settle to that new level and we're being compensated for it, then we're right back to where we started, right? As long as I'm being compensated for the level of inflation, and bonds are supposed to have the risk-free rate, we're going to have some compensation for term premium, and if there's a spread component, we're going to get compensated for that. As long as it's in the sauce, then I feel fine with it. And yeah, I'm not thinking runaway inflation. That would take a whole different kettle of fish. What I worry about is sort of knock-on effects, and then there is this second order. If the nature of trade in the world and supply chains change, does that have an impact on pricing? And that's, again, maybe that's an after Q&A dialogue if anybody wants to have it.
I have a question on private credit. I always look for in cycles over the years, referring to Warren Buffett's comments about who's been swimming naked. You don't know until the tide goes out. I would suggest that private credit, your comments on private credit were only related statistically. But what's been going on is I've been reading under the surface until the 2 bankruptcies happened and became public. There's a lot of bad stuff going on, a lot of bad loans. Jim Grant has written about this. I know Jim's always early, but he's usually right. And he is very concerned about this. His latest about the private equity firms are buying have bought insurance companies, and now have been dumping a lot of the loans that they can't exit into the insurance companies' portfolios with rating agencies that are the two that are below Moody's and S&P. I think Eden is one. Yes, he called them these 20 guys living in a house in some place that are giving ratings that are terrible, allowing insurance companies to buy all these bad assets they can't. It seems to me that's an area that we should be concerned about. And what's your comments on that?
Yeah, my comments in private credit, I was trying to keep it to the beta itself, because there's a huge idiosyncratic discussion that exists in private credit. I had two big mentors that came after I'd been in the industry for about 10 years. When I went to AllianceBernstein, the head of fixed income, a gentleman named Doug Peebles, and his first in command, Paul Danoon, who was one of the first investors in the nascent Brady bond market. Yeah, and Paul taught me a lot of things, but one of his, and again, since I live in the debt world for so long, one of the biggest things that stuck with me is always beware when demand creates supply. And so when I make comments about private credit as an asset collectively being something that over time can generate a strong up-down capture ratio because of the makeup of an explicit liquidity premium and the ability to directly attend to the loan yourself and to control the lending, what's inherent in that is that this is a case-by-case thing. I see opportunity in private credit, and I will love credit for the rest of my life as a bond guy, but at the same time, anytime that you have an ocean of capital come into a space and force the hand to lend, it terrifies me. So let me be crystal clear. I think there's great opportunity in private credit, but to lean into my comments earlier, pay close attention to the denominator. The onus is on us in homework to understand the nature of those loans, who they're lending to, what the mechanism is to encumber assets, because you're exactly right. I went through that in 2008. I went through the same equivalent of that. Remember, that was when I had true stories of mortgage brokers that were former bus drivers, yoga teachers, all of that stuff. And I came up with the lending trees moniker. When lenders compete, you win. Not always. When lenders compete, you get Cov Light. When lenders compete, you get ninja applications. When lenders compete, you don't have general oversight. They start to release that. So, no, to be very clear, as an asset, private credit to me is very interesting. But with the amount of money that comes in and has to be deployed, I've been leaning into this idea of manager by manager, loan book by loan book, how it is sourced, how it is analyzed, how the assets are encumbered. The onus is on all of us to do that homework, because if not, we will be exposed. I have no doubt that if something cracks in our space and we do have an economic rollover, a decent amount of that's going to be revealed beyond just the headline stuff that we have. So opportunity, yes, but due diligence is on all of us.
Hi, I just wanted to say I really appreciated your comments about the long-term historical view, the Deng Xiaoping and the world's largest factory floor and so on. I wanted to know your thoughts, though, about foreign capital recycling. We saw a lot, in the last few weeks, especially with the Greenland dispute and so on, some worry around European investors and foreign investors, we're talking about the Sell America trade here, wanting to buy U.S. bonds. And I wonder to what extent you think there might be monetary support really coming from that foreign capital recycling that might support, markets if we had a downturn. And, it seems to me that with, $8 trillion or so of U.S. assets owned by European entities, that if the appetite for those countries to buy U.S. assets falls, then that can really affect the long-term trajectory of rates, inflation, and markets.
Yeah, that's we've had quite a few chats around that. We have breakdowns of all the whole. I mean, it's not hard to get. It's not like the S&P 493. We can all get to that number. And if there was a decision to en masse, drop this away, that's a problem. One of the biggest questions I get asked is about debt sustainability. right? This is the level of debt to GDP. This is the amount we're issuing. These are the deficits. What causes it to crack? What causes it to crack is if we don't have enough people to buy it. It's as simple as that. Japan's debt to GDP ratio makes ours look like a nice effort at the moment, and yet it supports itself for a long time. But now we get into the headlines the last couple of weeks, a couple of things start to crack. I think some of that might actually be trading as much as anything, but that's a separate conversation. And so, yeah, in the end, the only way that debt markets function for any entity, private, public, is somebody has to be a buyer on the other end at a tenable level of yield. For years, I've been asked when the bond vigilantes would show up. And during COVID, whenever you'd see yields move up, someone would say, well, here we go. And there'd be a James Carville reference again, right? For those who remember James Carville, I'm trying to see if there's some that are like, who's James Carville? Okay, so James Carville was with the Clinton administration. You'll still see him on the news. He'll make comments today. But his famous quote, and I'm going to paraphrase, hopefully not butcher it, is he said, I used to think when I was a kid, if there was such a thing as reincarnation, I'd want to come back as like the Pope or a 400 hitter. But now I realize I want to come back as the bond market because it intimidates everybody. Yeah. And so and when this started happening again, I saw that meme with Carville start to pop up, right? Debt is sustainable as long as people have faith in its ability to pay. And this leads me back to this idea before. How much of what's taking place in terms of actions are malleable, and how long do we have until it becomes entrenched? Now, I do think it's a bit of a long road to hoe at this point to assume that the whole world will decide not to own treasuries, not least of which because we buy such a massive amount of them ourselves. But what I would ask myself is this something that as of now, markets are seriously considering? And at least from a trading perspective, we have our master of treasuries, and he's a very good friend of mine. And up until now, there's no real meaningful sign of any of that. But all that can always change, right? It can always change. But at the moment, that plus anecdotal conversational stuff that's happening with our bond guys and some of these folks in other countries on these sovereign entities that are making these purchases is that there isn't an intention to make wide reductions. But those things can change. So I don't have a good answer as to what a tipping point looks like where there's no coming back from it. But I think from what we're picking up, the tenor is that same question. We believe that this too shall pass. This level of what we're experiencing isn't permanent. And an easy way to see that is every time we have a significant drawdown, for the most part, you'll get a bid into treasuries. Now, what's interesting in Europe is, as some of you might know, there's been an interesting sub-trade of buying treasuries but hedging the dollar. So that's a really interesting point too, is like since Bretton Woods, really, I would argue, you have this coupling of the treasury and the dollar toward a reserve currency and the safe asset for the world, and they both help support each other's co-status. And so I would say my canary in the coal mine is how persistent is this decoupling in some investors' minds, mostly in Europe, but some other stuff. How persistent is this decoupling of an opinion between the behavior of the dollar and the investability of the dollar, reserve currency managers and the percent holding of the dollar, and then separately, their interest in continuing to hold U.S. treasuries. At the moment, I've seen more stuff on the currency side than we've seen evidence in treasury auctions of foreign buyers dumping or dropping out from what they've done before.
Follow-up question. It's quick, but we haven't gotten to them yet. So we got a lot of European countries that are deficit spending now to finance defense. Do you think that there might be a crowding out effect from the Germans in particular spending on the military, where people would be like, I'll buy the German bullet, and that just like saps demand from U.S. treasury auctions? And
has a negative effect?
That's a great question because my first answer would be people should be doing that right now. Not. So let me clarify my answer. Because right now, so I was a global bond guy. So when you buy a bond, and my wife is, I don't know if I mentioned this already, my wife is from Munich. We met because she worked in the Munich office of AB. So, vielen Dank. So the specter of my wife is present because I have certain rules that have been set to me around how many times I can attempt to do a German accent when she is not present and how much I can say about Germany. So I'm going to try to stay within those guidelines because this might be recorded and stuff would hit the fan. But what I would tell you is when you buy a German Bund, it's denominated in euros. You buy a JGB, it's denominated in yen. You buy a US Treasury, it's denominated in US dollars. But what has been available to everybody in this room, everybody around the world, is because people say, oh, well, the reason I'm not buying a Bund is I have to take on the euro exposure. I'm not necessarily afraid of the JGB, but I just don't want the yen exposure. But in global fixed income portfolios, we can hedge the currency out and keep the rates, right? But what's functional about that is that the yield of your bond when you hedge can increase or decrease based upon the difference in the short rates of the two countries and the tenor of the hedge that you use for the currency. And right now, as it stands, if you stack up bunds and loonies and gilts and Aussie all around the world, you will find that a lot of those bonds, much of the yield curve, once hedged back to the US dollar, out yields US Treasuries at most points on a curve. So right now, I could make a case, even without the crowding out question, that if you were okay diversifying yield curves across the world and hedging it back to the dollar, you actually pick up somewhere around 100 to 150 basis points in bond yield, in sovereign bond yield. Now, of course, you do pick up a little bit of sovereign risk. If you buy the German Bund, you wonder how much of the rest of Europe's price tag you're carrying along with you as the cosigner for Europe. But yeah, and so now so on the one hand, reminds me of the whole, what was it? Was it Truman with the one-handed economist comment? Was that the anecdote? Right? Okay. So I only want, the whole one-handed economist. So next time I want a one-handed economist because they're always like, well, on the one hand, right? But I'm pumped. So on the one hand, I'm surprised people haven't already been buying global debt and hedging it back to a base currency and getting the yield pickup because it's meaningful. Which always makes me wonder, as much as we all collectively know, there are these inefficiencies in markets. Because there is generally a home country bond bias that tends to exist, right? And we don't, certainly in the US, we tend not to break free of that. So one is we're not already buying even when we theoretically could have picked up from it. But yes, if we're in a new era where now defense spending is going to pick up and it's going to have to be funded and there will have to be a central cosigner and everybody else is going to sign on to it. If you're over in Europe, and this is back to the stick-to-itiveness of the current state versus the forward state. If you tell me this too shall pass, I can imagine a more diversified portfolio where Europe holds a little bit more of their own and they hold more of US Treasuries. But Treasuries would still get a bid. What the settling rate might be, maybe it's 15 bips higher. Maybe it's 20 bips higher, but I think there's a settling rate to that. That's different than Treasury avoidance. If there's a conscious decision simply not to own for one reason or another, that's different. There would be some level of crowding out. The question is to what degree that moves yields. And as yields move up, does that increase demand for yields the moment you pick up, say, another quarter point? And what's the actual settling turn out to be?
Richard, probably most people in this room have noticed that the price of gold and silver have gone hyperbolic. And gold right now, as you know, is $5,400 an ounce Troy, and silver's up at $117 an ounce Troy. So the question is, what do you see as the drivers, and what do you think this move is giving us as far as the message in the markets?
So for me, it falls in the same camp again, right? So I'm going to oversimplify this and just say, let's say that I have some amount of money to invest, and my natural home for that would be in a US dollar denominated US Treasury. And I think that, prudence in this case is the better part of valor. And so it's easy enough for me to just diversify. Because for many people, a treasury is in and of its own right a form of a store of value too. And so what do we usually say when we talk about gold and everything else, right? Gold I know there's some people like, gold is productive. Yes, okay, but generally speaking, it's a pretty rock. And so I think that's just, again, a reflection of question marks around where that money would have ordinarily gone, and it finds the home there. And we live in a world, especially post-08, of algorithmic trading and pile-in and trading momentum. In COVID, I thought this, I don't know if I said it earlier, when treasury yields would pop, we would talk about, we would say, okay, the bond vigilantes are showing up, and it was really a trade, because the moment you had one little bit of news, there'd be almost like a short cover on treasury yields, and they'd come ripping back down. There were a couple instances with 2-year treasury where it just flew back down again. And so we're back to the stick-to-itiveness of this. So maybe the impetus, the catalyst, and I can't speak for all investors and their initial motives, but one part of it becomes, hey, I'm going to diversify my safety assets. What are the classic stores of value? What is it, the Cross of Gold speech, bimetallism? By the way, inside baseball, I didn't know this until a handful of years ago, that the Wizard of Oz, inside of it, the central narrative hidden inside of the Wizard of Oz is the argument for bimetallism, for and against bimetallism, that existed back at the time when Frank Oz wrote it, or whatever, wrote The Wizard of Oz. And Frank Oz. Anyway, so for example, the Yellow Brick Road, gold, silver was Dorothy slippers. People are always like, well, those are ruby. No, that was because Wizard of Oz was one of the first 2 films in Technicolor. Gone with the Wind was the other. And for pop, they wanted the door to open from the house and you'd see Oz, and they thought ruby slippers would pop more. But if you look inside of it, the Scarecrow is agriculture, the Tin Man is industry, like there's all the characters. It's crazy. It's like Hobbit with a message, right? I sort of lost my train of thought because I love that story, but I know. But so the store of value idea and gold and silver and its use as a store of value, the ability to trade with it, the supply of gold and silver, that's gone on forever. And the argument for both back and forth, it's back again to how permanent is that? Or 5 years from now, 7 years from now, are we not having this conversation? But what I would say is what I've been saying for years, when they say gold or silver, I've said copper.
We got one more. Okay.
So over the next 5 years, you can only invest in 3 countries. Which 3 countries would you put your money in?
Over the next 5 years, I can only invest in 3 countries. Which 3 countries do I invest in? This is a tough one for me because I would usually go around the globe and pick companies or industries that I like across countries. But I'm a bond guy at heart. First and foremost, I'm going to choose the US. There's no way I'm not choosing the US for all the reasons that we know, and because I have the right to choose what I invest in inside of the United States. So regardless of how I feel about AI one way or the other, I can find what I want inside of that market. I'm a little worried about the size of the German market, but I'm going to be present inside of the German market. I'm going to stay away from emerging. There's a and because it become pretty idiosyncratic. But I'm actually going to put Japan into this mix. But these are all idiosyncratic choices because now I can pick and choose inside of Japan. And there are some reflation trades inside of some of the companies inside of there, some of the automation that they're using inside. So they're individual companies, and I don't think that everybody else would be going after them. So I'm choosing Japan as my idiosyncratic. I like some of the companies I can choose there. I'm choosing Germany as the center of Europe because I can feel comfortable with the debt and also some of the general investments that we're talking about from defense and energy. And so inside of those investments, I have a bit of a diversification against my more tech-heavy U.S. exposure, and I can spread debt from 3 different nations, assuming Japan keep paying, baby, keep paying. I can get the debt of 3 of the largest issuers and those that have a history of paying the debt. So I can sort of get diversified equity exposure through the 3 countries, and I can get 3 different types of debt. And again, I hedge it back to the dollar.
Rick, thank you. I do have one last question for him. You do need to provide a price target for the S&P 500.
Dow 50,000. Yeah, I've 7750. 7750.
Strong. I like it.
360 on the 10-year Treasury. 1 year forward, right?
All right. Well, please give it up for Rick from AllianceBernstein.
Thank you.
And we have a gift for you. Again.